This video aims to provide you with some clarification about the WACC model homework, as well as giving you a demonstration for finishing up the calculation of WACC. So first of all, the first clarification is about the calculation of stock and market return. As you may find out that the prices that you download from Yahoo Finance looks a little bit different from the prices showed up here from what I downloaded from Yahoo Finance. So the reason is that I downloaded in some years before. So at that time, the prices of SPY and the prices of CAD has not been adjusted due to future stock splits or dividend payment. So the reason is that, let me show you an example. So every time when so Caterpillar, issue dividend, the prices, the adjusted close price here will be adjusted. The close price open high stays the same, but the adjusted close price will adjust this such that it incorporates this 1.3 dividend. So when you calculate return based on the adjusted close price, it is the returns that include dividend payment. So we talk about it in some of our previous classes that return is a return, total return that includes capital gain, which is the price changes, as well as dividend yield. So dividend yield is coming from here. So if you want to measure the total return of a company, of an investor's investment into the stocks, investor can gain from the price appreciation. They can also gain from the dividend payout. So in this case, when Yahoo Finance provides the adjusted close price, it wants to provide a close price that you can use for calculating return, and that return is a kind of total return that includes price changes as well as the dividend payment, so that you don't need to additionally add dividend payment to your calculation of return. So pretty user-friendly variable, but only issue is that the prices that I downloaded today will be different from the prices I downloaded probably a year later, because a year later, during the future years, the company will issue more dividend and the historical adjusted close price will all be adjusted. So that means even though the time has passed, the adjusted price will keep on changing in the past. So the historical prices, adjusted prices here will also change. So every time when there is a dividend issuance, it will update all the historical price of the company. So I'm just talking about the data feature of Yahoo Finance. So it doesn't really apply to all the price data provided by all the database. So let's say if you use some prices from Bloomberg, you need to make sure that that price is the archive price that never change, or it is the price that will be constantly updated. So it will be backfill. So in this case, let me see the end of 2020 price. It was updated to 170. And from the time I downloaded it, it was 177. So that's the difference that you can see, and probably is the difference that you found out from your work of this question. So I would say it doesn't really cause any issue about our calculation, because ultimately we will be using return instead of raw prices. So in this case, the return will not change. So even though prices are adjusted, but the historical return of this stocks remains the same. So that's the beauty of doing this adjustment. We will never want to affect the value for return, historical returns, even though the prices were changed. So the changes in prices should be consistent over time, such that we get a return that are the same as the return that we calculated before. All right, so to summarize, so the prices here, you can just download it from Yahoo Finance as it is, even though it may look different, but just make sure that when you calculate return, you are following the right formula for calculating return, and you are also having the same percentage return as I did here. So we talk about using log return in our class exercise. Here we are using percentage return. So at the high frequency level, like daily, sometimes monthly will also borderline high frequency if you think about quarterly or annual return. So at high frequency level, log return and percentage return does not matter that much. So here you can use log, you can also use percentage return. And then the next clarification I want to make is the calculation of dividend growth. So if you look at the last page, our calculation for WACC is based on 2020. So we want to calculate the WACC for CAD in 2020. So let's say the end of 2020. So therefore, when we're using information about dividend growth, we shouldn't use any future information after 2020. We should assume that all the available information to us are up to the end of 2020. So there's no way for investor in 2020 to have any information about the prices or dividend growth realized and actual dividend growth in 2021 and 2022. So therefore, I want to make a small adjustment for the dividend growth. So at the time I downloaded the data for dividend growth, that was probably already 2022. So so that's why I included here. But for the sake of this question, as we want to assume that we are at the end of 2020 or we are in 2020, so we shouldn't include the data, any information after 2020. So effectively, when we calculate dividend growth here, we shouldn't use the information in 2021 and 2022. Of course, in practice, this wouldn't be a problem. In practice, once you become a practitioner and professionals, you wouldn't be able to have any of the future realized dividend. You can have an estimated future dividend, but you wouldn't have these actual data for CAD about its future dividend issuance. You may have about their scheduled dividend issuance in the future quarter, but you probably can't have all the schedule of dividend issuance in a few years later. So so that's why in practice it wouldn't be a problem for you. In our homework, I would recommend and encourage us to just restrict ourselves to the information available prior to the end of 2020. So I will change the last 4-year dividend growth rate to the end of 2020. So going back from 2020, so these are the four dividend payments for 1 year, 4 dividend payment for another year, and then 4 dividend payment for the 3rd year, and 4 dividend payment for the 4th year. So we have C8 divided by C23, and then raise it to the power of 1 over 4 years. So that will be the last 4 years dividend growth rate. And then for the entire period, we'll have end of the period dividend issuance and the beginning of the period dividend issuance. So the difference is not that much from just looking at these two values. One is 7.5, another one is roughly 7%. So these are the two clarifications that I want to make. Now I want to move on to the calculation of WACC. So because the data I downloaded, the price data I downloaded looks a little bit different. So that's why I have 177. So if I use the updated adjusted price, it probably will be 170. So I would say in practice, there's never an issue here. So you will just use the current stock price of the company as the most up-to-date share price. So in this case, let's say you want to calculate the weighted average cost of capital for CAP in 2023, the prices will be this one. So here I'll stick to 177, or you can also use 171. I don't think it will make a big difference. So here, let's just go ahead and calculate cost of equity. So I want you to have an overview first. So we have a couple of models. We have 3 models for calculating cost of equity. So model 1, based on the constant growth dividend model. Model 2, based on also constant dividend growth model, but we're replacing dividend growth by equity payouts. And finally, we use kind of market-based model. So we use capital asset pricing model to calculate the cost of equity. Well, at the very beginning, or the original spirit of capital asset pricing model is to calculate the expected return for the investor towards the company. And since the expected return, we can also think it as a kind of required return by the investors. So when investor invest in the firm, they are requiring a certain amount of return for their investment. So for the firm's perspective, these are the return that investor require for the firm will be the cost of using the equity investment, the cost of using equity financing. So therefore, we use it different terminology interchangeably. So cost of equity also is expected return of investor, is also required rate of return of investors. So we have 3 different models here. And the weighted average cost of capital, the calculation is just weighted average. So we are just changing different cost of equity for calculating weighted average cost of capital. So then let's go ahead and start. So current dividend is coming from our previous data here. So I would use the 2020, end of 2020, 1.03. And then since this is quarterly dividend, so I will times 4. And then for the growth rate, so I will use the most recent one. The reason is that first, it's not that different, 7% versus 7.5. Second, the recent 4 years, I believe it's 17, 18, 19, and 20. So I would argue that these are more relevant comparing to the more remote years in the history. And then cost of equity. So for your convenience, I have attached the model here already. So we'll just plug in the number. So equals to dividend times 1 plus growth rate divided by the price plus growth rate. And then for cost of equity, so since we will only be changing cost of equity, so all other things will be fixed and will not change when we calculate other WACC over here. So I will try to demonstrate a easier way to save some of our efforts in terms of inputting the formula. So first I will do cost of equity times the weight of equity. The weight of equity will be the equity value divided by the equity value plus the debt, the value of debt. And then plus cost of debt times the weight of debt. So it will be the debt value divided by equity plus debt. So the last thing is we need to do a tax adjustment for cost of debt, since using cost of debt will give us tax benefit. So it will effectively reduce our cost of using debt, because when we pay the interest related to the debt financing, that interest is tax deductible. So we can use that amount to subtract it from our earnings, and then reduce the company's tax liability. Effectively, then if the earnings has been reduced pre-tax, the company can therefore pay less tax. So that's a nice thing about raising capital through debt. So the tax adjustment will be 1 minus tax rate. So as I mentioned, that all of these parts will be fixed when we're calculating the following WACC. So we will be just changing B15, the model for calculating cost of equity. So therefore, I can probably just fix all of these cells. So by pressing F4. Enter. And then moving on to the next WACC, which is using the cost of equity based on equity payout. So this is simply to relax one of the assumption that constant dividend growth model make. So that model can only apply to those firms that pays dividend. But if a company do not pay dividend, but it pays some form of payout like repurchase, in that way, we also want to make our model. In that way, we can also use Gordon constant growth model to measure it. So we can simply measure the total equity payout. So this will be a data that are available from our previous calculation here, using the most recent total equity payout. And then the growth rate. So there are a couple of growth rate here. One is based on the 2-year growth, another one is based on 1-year growth. So I will discuss later. Some of you may already feel hesitated when they see the negative growth rate. I'll first not think about it, just use it and discuss it later about the issue of using a negative growth rate. So I will follow the formula on the right-hand side here. divided by the market value plus the growth rate. And then for calculation of WACC, I can simply copy it down. And then copy it down here as well. And this is not the final answer yet, because currently the cost of equity based on CAPM is empty. So we just need to calculate the cost of equity based on CAPM. So we first need risk-free rate plus beta. By the way, the risk-free rate now is roughly 5%, which is dramatically different from the risk-free rate that we have a couple years ago. Market return minus the risk-free rate. Okay, so usually at the end, our estimated weighted average cost of capital will be the average of all the different models that we use. But we want to be very careful about one outliers here that we saw clearly. When you see here, we have a negative WACC. A negative WACC does not make sense, and we should never include it in our consideration for making our final projection of WACC. So the reason is that if we have a negative rate for using a cost of for using a capital, this simply means that investors, they don't care about their investment return. They just want to keep money to the company, and every $1 that they give to the company, they will offer an extra 18 cents. So so that doesn't really make sense. Investor, they do require return. So therefore, a negative WACC does not make sense here. And the reason that caused this negative WACC is this negative cost of equity. And the reason that we have negative cost of equity is because this negative growth rate for equity payout. So if investors sees negative equity payouts, a simple intuitive consequences will be, I'm not interested in investing in the firm anymore, because the firm never share its profit, or they are not able to make profit. So then instead of rushing to the conclusion of the profitability of the company, let's see what happened. So what results in the negative equity payout. So so if you look at share issuance, so the amount is minimal, so it's almost insignificant when you compare it to dividend and repurchase, and it's also stable. So no question here over the recent 3 years issuance. So for dividend, it actually have a pretty stable growth. So no issue here for dividend as well. The issue is the repurchase. So repurchase is not that stable. We discussed it in class that repurchase is not a strong commitment. So the company does not really need to try to commit to a consistent repurchase. They can do repurchase this year, they can stop repurchasing next year. So then their main way before 2020 their main way to share their profit with investors is through the repurchase program instead of dividend. You see that repurchases in 2019 is 2 times of dividends. So that's probably their major way to share their profits with investors. So, but in 2020, we all know what happened in 2020. So not just CAD, but a lot of firms also temporarily suspended their repurchase program. So we see a significant drop in their repurchase amount. So the total repurchase amounts was largely shrunk to roughly 1130. So it's an unusual year. So when we consider the growth rate of equity payout, we probably should not include this extraordinary. We probably should not include this 2020 into our projection of future years, unless we think that there are some things, some other shocks going on in the future. So here I would recommend us not to use any of the growth rate that consider 2020. So negative 23% consider 2020. So the ending period value is the value in 2020. So this results in a negative growth rate. The 1 year growth rate will also use the ending value that's arise from the 2020 data. But if we only consider the annual growth rate from 2018 and 2019, this looks a little bit more reasonable, 9%. If I want to be do a little bit more, go above and beyond, if I want to make my own equity analysis for CAD, I probably will go further. So I probably will also found the data before 2018. So looking at the data for 2017, 16, 15, and even more to see, basically I want to gauge a kind of normal, regular equity payout growth for Caterpillar, a growth that they are able to sustain in the past years without any significant shock in the macroeconomy. So in this case, I will recommend two ways to remedy the negative shock, the COVID shock, when calculating WACC. So I will either exclude this negative rate, just taking the average between the first and the third model. So I get 10.91. Or I'll change this rate to a rate that is more reasonable. So 9.29, excluding 2020. And then take the average of the three different estimates. Hold on. So there's an issue here. I think I changed the growth rate to a wrong number. So here, change it to 9.29. And then cost of equity was changed to 12%, 11% for WACC. So then taking the average of the three. So then it's roughly 11%. And you'll be able to see that 10.91 is basically very close to 11%. So in the very beginning of our module, so I kind of talk about the average, weighted average cost of capital for US firm. So it's roughly 10 to 12%. And the estimate of our calculation is roughly 11%. It's falling nicely within the range. So we can therefore feel pretty comfortable about this calculation here. In some cases, when you see your WACC calculation is way too high or way too low, so then we probably need to look into the assumption that the rates that we are calculating, the assumption that we are making. So like this case, we probably, when we see a negative growth rate, we probably need to see what happened to the firm in that particular year, or what caused this abnormal data. Right, so that will conclude the assignment and our model demonstration.